Ladies and gentlemen, the Federal Reserve has finally cut Fed funds rate in response to ongoing weakness in the US labor market. And as it started to become crystal clear that the Fed is not going to have any other option but to cut rates in its September meet, equity markets around the world started to rally weeks in advance in anticipation of the Fed resuming its rate cut cycle in its September 2025 meet. But now that the Fed has resumed its rate cut cycle, how is it that we can expect equity markets to behave in the weeks and months ahead? Is it time for the equity market rally to accelerate from here? Or is it time for an interim pullback in equity market? And most importantly, is there any such magic global macro parameter that can potentially help us get out of equity markets before the next interim pullback in equity markets starts to play out? Ladies and gentlemen, that's exactly what we are going to discuss in this video. So please do watch this video till the very end without skipping. Ladies and gentlemen, hi. I'm recording this video on the day after the Fed Open Market Committee, or the FOMC, met and decided to cut Fed funds rate by 25 basis points. This rate cut decision has of course come on the back of a dramatic deterioration in US labor market conditions over the last 2 months. But it is worth noting that up until as recently as July of 2025, which is when the FOMC met for the last time before its yesterday's meeting, that the Federal Reserve Chairman was not even ready to as much as acknowledge any kind of weakness in the US labor market, let alone set a timeline for rate cuts in order to support the labor market. And yet, here we are in September of 2025, and the Fed has been forced to not just acknowledge the weakness in the US labor market, but to actually cut Fed funds rate in order to support the labor market. Now, for anyone who has been following me on my YouTube channel, this should not come as a surprise because I've been literally shouting from the rooftop in all my recent videos that the Fed has been outright wrong in not acknowledging the weakness in the US labor market. For example, in my last video, which was published on 11th of August 2025, I explained how Jerome Powell has been dead wrong in not acknowledging the emerging weakness in the US labor market, and how two back-to-back monthly payroll reports published by the US Bureau of Labor Statistics, that is the BLS, has demonstrated beyond all reasonable doubts that new job creation in the US labor market has completely collapsed now. Not just that, in this video as well as in other recent videos of mine, I've also explained the implications of the Federal Reserve having to resume its rate cut cycle in response to weakness in US labor market. For example, in this recent video of mine, which was published on 1st of August 2025, I explained in very many details how the resumption of the rate cut cycle by the Federal Reserve in response to weakness in the US labor market would ultimately pave the way for a melt-up of sorts in equity markets around the world, including here in India. If you haven't had a chance to go through these two videos, I'll strongly urge you to go through both of them. I'm going to leave a link to both these videos in the description of this video. And the reason I'm urging you all to go through these two videos is because only if you go through these two videos will you realize that the way things have played out in financial markets over the last 2 months has been pretty much a word-by-word enactment of the script that I had laid out in these two videos. To begin with, the Federal Reserve was first forced to acknowledge that labor market conditions were indeed becoming very, very tight. Thereafter, as it became very, very clear that the Fed will be forced to resume its rate cut cycle because of the weakness in US labor market, equity markets around the world started to witness a very, very strong meltdown. This meltdown, of course, has been most pronounced in the United States, where all the leading indices are now at new all-time highs. This meltdown rally has admittedly been a little muted here in India compared to the rally in the United States because of the overhang of the steep 50% tariff imposed by the Trump administration on all goods and merchandise imports from India. But despite the overhang of tariffs, even Indian equity markets have somehow managed to grind their way towards the upside, even if at a slow and steady pace. As we speak, the Nifty is just about 3% away from its most recent all-time high. But my dear friends, now that the Fed has resumed its rate cut cycle in response to weakness in the US labor market, how is it that we can expect equity markets to behave in the weeks and months ahead? Well, the answer to that lies not in the equity market, but in the bond market. And within the bond market, we have to look at two key interest rates. The first one is the US government 10-year bond yields, which is what I have plotted for you on your screen right now. And the second one is Fed funds rate, which is what the Fed cut by 25 basis points yesterday. And it's the interplay between Fed funds rate and US government 10-year bond yields, which is likely to be the most important driving factor for equity markets in the weeks and months ahead. So let's understand what is this interplay between US government 10-year bond yields and Fed funds rate all about. The red line that you see on your screen right now represents the historical yield of a US government 10-year bond. 10-year bond yield basically represents the annualized return, the annual yield that you can generate by investing in a US government bond of a duration of 10 years. The Fed funds rate, on the other hand, denotes the annualized return, the yield that you can generate by investing in US government bonds of a duration of one night. Is basically the overnight lending rate. Now let's add in these two vertical pink bars. These two vertical pink bars represent periods when the US economy slipped into a recession the last two times. Also, we can see in the chart that US government 10-year bond yields have historically been pretty good at foreseeing the onset of a recession in the US. As you can see in the chart, as soon as the bond market can start to sense that the US economy is slowing down and is likely to slip into a recession, the US government 10-year bond yields typically start to witness a very steep decline in the run-up to a recession. Now let's add in the Fed funds rate. Fed funds rate does the same thing. As soon as the Fed can foresee that the US economy is slowing down and is likely headed into a recession, the Fed also starts to cut Fed funds rate. But the bond market is usually more efficient at sensing the onset of an upcoming recession in the US. And that's why historically we have seen that US government 10-year bond yields start to decline far before the Fed can sense an upcoming recession and start cutting Fed funds rate. Now, to better understand the interplay between Fed funds rate and US government 10-year bond yields, let's zoom into this chart and take a closer look at the period in the run-up to the recession of 2008. As you can see in this chart, the Fed started to cut Fed funds rate in September of 2007, and we got the onset of the recession from January 2008 onwards. So there was a 4-month period between the points in time when the Fed started to cut Fed funds rate and the onset of the recession. And as you can see, during this 4-month period, the Fed cut Fed funds rate as many as 4 times. And alongside the decline in Fed funds rate, US government 10-year bond yields also started to decline in tandem. And whenever Fed funds rate, which basically represent overnight lending rates, and US government 10-year bond yields, which represent long-term lending rates, both of them come down in tandem, that usually makes for very favorable conditions for equity markets. That's why we got very strong rallies in equity markets around the world during this 4-month period. Here in India, the Nifty rallied by a staggering 38% during this 4-month period between September of 2007 and January of 2008. But that's not to say that equity markets only go one way up during the course of these strong melt-up rallies in the run-up to a recession. You must keep in mind that even as these melt-up rallies in the run-up to a recession play out, it's very common to have instances of divergence in trend between Fed funds rate and US government 10-year bond yields to emerge from time to time. And whenever there is an instance of a divergence in the direction of Fed funds rate and US government 10-year bond yields, it usually leads to an interim pullback in equity markets. For example, back in 2007, even as the Fed started to aggressively cut Fed funds rate from September 2007 onwards, there were 2 instances where US government 10-year bond yields started to witness a spike towards the upside. Both these instances of a spike in US government 10-year bond yields were brief, but they were sharp spike in US government 10-year bond yields. Within a very short period of time, on both these 2 instances, US government 10-year bond yields spiked by almost 50 basis points. And this led to a divergence in the direction of Fed funds rate and US government 10-year bond yields. Fed funds rate were coming down, whereas US government 10-year bond yields during the course of these 2 instances of divergence started to go up. And whenever there is a divergence in the direction of Fed funds rate and US government 10-year bond yields, that's usually not a good thing for equity markets. That leads to heightened volatility in equity markets. And that's why during this 4-month period, even as the overall direction of the equity markets was towards the upside, we witnessed as many as 3 instances of the Nifty pulling back by more than 5%. First one was an interim pullback of 9%. The second one was a pullback of 7%. And the third one was also a pullback of 7%. So in summary, whenever Fed funds rate and US government 10-year bond yields, both of them come down in tandem, that usually makes for very favorable conditions for equity markets, and during such times, equity markets tend to witness very strong rallies. However, whenever there is a divergence between Fed funds rate and US government 10-year bond yields, that's usually not a good thing for equity markets. And during such times, you can get pretty steep interim pullbacks in equity markets. Now let's move forward to 2024, which is when we witness one more instance of a divergence in trend between Fed funds rate and US government 10-year bond yield. As we know, the Federal Reserve started to cut Fed funds rate from September 2024 onwards, because by September it was pretty clear to the Fed that the US economy is distinctly slowing down. However, once again, we can see that the US bond market had sensed the onset of this slowdown much before the Fed could. As a result, US government 10-year bond yields had started to decline much before the Fed started to cut Fed funds rate. However, this trend of US government 10-year bond yields declining abruptly came to an end in September of 2024. And as you can see, after September 2024, US government 10-year bond yields, in fact, started to go up. And this was because of the aggressive pace at which the Fed started to cut Fed funds rate from September 2024 onwards. The Fed kickstarted its rate cut cycle in September of 2024 with a larger than average 50 basis point cut on 18th of September 2024, and then the Fed backed it up with two back-to-back cuts of 25 basis points in October and December of 2024. And this gave rise to apprehensions amongst bond market participants that the Fed is possibly cutting Fed funds rate by too much too soon, at a time when the US economy, even though slowing down, was still growing. And in an economy that is still growing, if rates come down by too much too soon, bond market participants feared that inflation can potentially stage a comeback. And as a result, bond investors started to drive up US government 10-year bond yields. Because US government 10-year bond yields are nothing but a compensation that bond investors demand from the US government to offset the impact of inflation. That's why if their expectation of future inflation is towards the upside, then they typically start to drive up US government 10-year bond yields. But as you can see on your screen right now, because of a sharp reversal in trend of US government 10-year bond yields that was witnessed after September of 2024, we basically got a huge divergence in trend between Fed funds rate and US government 10-year bond yields. Fed funds rate was coming down at a very fast pace, whereas US government 10-year bond yields were going up. And once again, this divergence did not work out very well for the Nifty. As you can see on your screen right now, from September 2024 onwards, the Nifty started to witness a pretty steep decline. In fact, as a result of this divergence, the Nifty went on to correct by as much as 16% between September of 2024 and March of 2025. Now, this is what we have to watch out for going forward, as the Fed has once again restarted its rate cut cycle from September 2025 onwards. So far, what we have seen is that US government 10-year bond yields have been declining over the last couple of months in the light of weakness in US labor market. And now, with some lag, the Fed has also taken cognizance of the weakness in labor market and has decided to restart its rate cut cycle. Not just that, the Fed has also indicated that it's likely to cut Fed funds rate 2 more times in rest of 2025. And if that happens, that would amount to 3 back-to-back rate cuts. And assuming each of these cuts are of 25 basis points, we would cumulatively end up with 75 basis points worth of rate cuts within a very short period of time. And mind you, all this is happening at a time when inflation fears continue to remain very, very elevated amongst bond market investors because of the steep tariffs that the Trump administration has imposed on imports from pretty much every trading partner of the United States. And these fears are quite logical. Tariffs leading to higher prices and in turn inflation is not an unfounded fear. And that's why we must watch very carefully at how the bond market is reacting to all the rate cuts that are likely to come in the months ahead. If bond market investors once again conclude that the Fed is possibly cutting rates by too much too soon at a time when the risk of inflation staging a comeback because of tariffs are still very high, then we could see once again a very abrupt trend reversal in the direction of US government 10-year bond yields. And that could well mean that US government 10-year bond yields can once again start to go up, which in turn would mean that we will get one more divergence in trend between Fed funds rate and US government 10-year bond yields. And if we do get any such divergence, that is unlikely to be a good thing for equity markets, and we could well get one more interim pullback in equity markets. Now, I'm not necessarily trying to suggest that we will get such a divergence and that in turn will necessarily lead to one more interim pullback in the Nifty, but this is something that we must watch out for. If we do get any such divergence, that is unlikely to be a very good thing for equity markets. That said, I must reiterate here that even if we do get any such divergence in trend between Fed funds rate and US government 10-year bond yields, then that in turn leads to an interim pullback in equity markets. It will be just that, an interim pullback. I am not predicting any kind of a crash in equity markets that typically coincide recessions. Now coming to the most interesting part of the video, which is that is there a market variable through which we can potentially time our exit from equity markets before any such interim pullback in equity markets can play out in response to a possible divergence in trend between Fed funds rate and 10-year bond yields? Well, once again, the answer to this question lies not in the equity markets, but in the bond market. And the bond market parameter, which can potentially help us achieve this seemingly unachievable feat, is something called the MOVE index. Now, the MOVE index is, of course, something that I've extensively discussed in this previous video of mine, which I had published on 9th of November 2024. If you haven't had a chance to go through this video, I'll strongly encourage you to go and have a look at this video. I'm going to leave a link to this video in the description of this video. But to summarize what I had spoken about the MOVE index, I have to go back to this chart, which depicts the historical trend of US government 10-year bond yields over the last 2.5 years. Now I'm going to add this red line to this chart, which basically represents the historical trend of the MOVE index since January of 2023. The MOVE index basically tracks volatility in the US government bond market. Those of you who are seasoned investors in the equity market would know something called the VIX, which tracks the volatility in equity markets. The MOVE index is in a way the VIX of the US government bond market. So the way this works is that whenever there is an abrupt trend reversal in US government 10-year bond yields, that by definition means elevated volatility in US government bond market. That in turn basically leads to a spike in the MOVE index. This is exactly what we got last year around September of 2024. We saw a little while back in the run-up to September of 2024, US government 10-year bond yields were already in a very, very steep decline because the bond market could already foresee that the US economy was slowing down very, very distinctly. However, after September of 2024, as the Fed started to cut Fed funds rate very, very aggressively, that led to inflation fears amongst bond investors. And as a result, bond investors started to drive up bond yields. As a result, there was a very sharp and abrupt trend reversal in the direction of US government 10-year bond yields after September of 2024. And that, by definition, meant very high volatility in the US government bond market. And in the light of the spike in volatility in the US government bond market, we had the MOVE index shooting all the way up to 136. Now, a MOVE index reading of 100 plus is usually considered to be indicative of very high volatility in the US government bond market. A reading of more than 120, well, that's considered dangerously high. By November of 2024, as you can see on your screen right now, the MOVE index had shot up to as high as 136. And the MOVE index shooting up to such high levels, as we're going to see in just a while in this video itself, is not a very good thing for equity markets. But before we get to the linkage between the MOVE index and the equity markets, let's cover all the recent instances where the MOVE index shot up to very, very high levels. The next time the MOVE index shot up to very high levels was in April of 2025. Now, as you can see in this chart, in the run-up to April of 2025, US government 10-year bond yields had actually started to come down very, very significantly. But this downtrend in US government 10-year bond yields abruptly came to an end on 2nd of April 2025, which is when US President Donald Trump announced the imposition of sweeping tariffs on pretty much every trading partner of the United States. China, which is one of America's largest trading partners, was hit especially hard because the Chinese government chose to retaliate on its part by imposing retaliatory tariffs on American imports. That in turn triggered Donald Trump to escalate the quantum of tariffs on Chinese imports to a level of more than 100%. And because of the potential inflationary impact of tariffs on imports, US government 10-year bond yields started to spike very, very sharply after 2nd of April 2025. And this sharp trend reversal in the direction of US government 10-year bond yields led to the MOVE index shooting up to as high as 140. In fact, most bond market analysts believe that it is the bond market revolt of April of 2025 and the move index shooting up all the way up to 140 is what forced the hands of US President Donald Trump and forced him to offer concessions to US trading partners. And on 9th of April, he announced the postponement of implementation of retaliatory tariffs by 90 days. In fact, we can clearly see that soon after Donald Trump announced the postponement of implementation of tariffs by 90 days, US government 10-year bond yields once again started to trend downwards. And over a period of time, this in turn led to the move index coming down to its current level of less than 75. This also means that we have to be very, very careful at this stage, especially now that the Fed has resumed its rate cut cycle. If the Fed starts to cut Fed funds rate too aggressively from here on, then that could potentially lead to fears amongst bond market participants about inflation possibly staging a comeback. And if that were to happen, then bond investors would invariably push up US government 10-year bond yields, as indeed they did back around September of 2024. And if we do get a sharp trend reversal in US government 10-year bond yields, then well, there's a very high likelihood that we could get a big spike once again in the move index as well. If you're wondering as to why we should care about a spike in the move index, well, the reason is that the move index is inversely correlated with the Nifty here in India. And to understand this inverse correlation better, we need to look at the move index and the Nifty in conjunction. So let's do that. So let's take the red line, which is the move index, a little up. And then let's add this blue line, which represents the Nifty's historical trend since January of 2023. And as you can see, the red line and the blue line are pretty much mirror images of each other. Whenever the red line, that is the move index, shoots up very sharply, the Nifty is usually witness to very sharp downtrends, and vice versa. As soon as the move index starts to trend downwards, the Nifty is usually witness to very strong rallies. Now let's zoom into this chart and take a closer look at the period after April of 2024. As we saw a little while back, the move index started to shoot up from September 2024 onwards and reached a high of 136 by 4th of November 2024. And this spike in the move index happened in response to a very sharp trend reversal in US government 10-year bond yields after September of 2024. And this spike in the move index in turn caused the Nifty to correct very, very sharply from September of 2024 onwards. We got yet another big spike in the move index, as we just saw around April of 2025, which is when US President Donald Trump announced the imposition of sweeping tariffs on pretty much every trading partner of the United States. And the resulting volatility in the US government bond market led to the move index shooting up to a high of 140 by 8th of April 2025. And this in turn caused the Nifty to correct very, very sharply in the first week of April of 2025. But as we just discussed, the revolt by the bond market and the resulting spike in the move index forced Donald Trump to extend a concession to US trading partners and announce the postponement of imposition of tariffs by 90 days. And as soon as Donald Trump extended this concession, bond market volatility immediately started to come down. And as a result, the move index has been in a very, very sharp downtrend ever since. And what's been the impact of the move index trending downwards on equity markets? Well, equity markets around the world have been witnessing literally a melt up of sorts since April of 2025. This melt-up has been most pronounced in the United States, where all the leading indices are now at new all-time highs. The resulting rally in the Nifty here in India has also been pretty strong. However, the rally in the Nifty admittedly has been under some pressure over the last couple of months because of imposition by Donald Trump of steep 50% tariffs this time round on imports from India. But despite the overhang of tariffs, Nifty has once again started a slow and steady grind towards the upside over the last couple of weeks, as it became clear that the Fed will cut rates in its September meet. But now that the Fed has resumed its rate cut cycle, we have to be very, very careful. We have to watch out for any sign of a sharp trend reversal in the downtrend that we have been witnessing in US government 10-year bond yields. Because a sharp reversal in the trend of US government 10-year bond yields going down would invariably lead to the move index once again starting to trend upwards. And if we do get a big spike in the move index going forward, that would almost certainly cause an interim pullback in the Nifty. So that's the framework I want all of you to keep in mind. If you get a big spike in the move index going forward, especially if the move index shoots up to a level of more than 120, that should be your cue to consider cutting down the equity exposure in your investment portfolio. And vice versa. As soon as bond market volatility starts to subside and the move index drops to a level of below 100, that should be your cue to aggressively increase the equity exposure in your investment portfolio. Ladies and gentlemen, at this stage of the business cycle, it is absolutely critical that you have a rules-based framework like this one if you have to navigate the ups and downs of the equity market. Because at this stage, there's simply no scope to take investment decisions with respect to your investment portfolio based on gut feel. At metacaps.ai, we have built a robust rules-based framework in order to drive our flagship AlphaSIP strategy, which is what we make use of in order to manage the portfolio of our clients who have entrusted their hard-earned money for us to manage. As part of the AlphaSIP strategy, we continuously rebalance our client portfolios between a bunch of high-performing equity funds and debt funds based on changes in not one, not two, not three, but more than 15 bond market as well as global macro parameters. And the move index is but one of the 15 plus variables that is part of our rules-based framework that we use to drive our AlphaSIP strategy. Our rules-based approach has enabled us to execute a bunch of fantastic trades over the last 1 year, which has enabled our clients to sidestep to a very large extent the correction that has been witnessed in the Nifty between September of 2024 and March of 2025, and also ride the rebound rally to a very large extent that has been witnessed in the Nifty since early April 2025. And that's why if you are one of those who is finding it difficult to manage your investment portfolio based on a very strict rules-based approach, then you can consider investing in our flagship AlphaSIP strategy. We offer the AlphaSIP strategy in 3 different variants, the details of which are there on your screen right now. And the variant which is most popular amongst retail investors is the first one, the AlphaSIP tax saver variant, in case of which, as long as the cumulative investment amount during the course of a financial year is within 2.5 lakh rupees and you continue to stay invested for a period of at least 5 years, the entire maturity proceeds can potentially be tax-free under section 1010D. In fact, this one is amongst the very few investment options left, if not the only investment option left, where the entire maturity proceed can be tax-free even under the new income tax regime. If you're interested in any of the 3 variants of the AlphaSIP strategy, then please go to our website metacaps.ai/products and register for the variant that suits your requirement the best, and somebody from our sales team will get back to you to take the discussion forward. Ladies and gentlemen, that's it for now. This brings me to the end of this video. I sincerely hope that you like the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you for taking time to watch this video, and goodbye till we meet again in the next video.